Well, good morning, everyone. I see people popping onto the webinar as we talk. Welcome, welcome. We'll wait till everybody is in before we get started. I hope you're enjoying your summer and staying nice and cool. If you're not here in Texas, you can be glad for that. We have a little cool down. We're at 101 today. And almost everybody is in. We'll give it just another minute before we get started. Okay, it looks like everybody's gotten in. Well, good morning, everyone. My name is Kelly Boofing, and I would like to welcome you to the Strip Matter Wealth Smart Money webinar series. So thank you for joining us today. Our presentation today is titled Active and Passive Management, a Closer Look. Now, for those of you that don't know us, Strip Matter Wealth Management Group is a registered independent advisor located in downtown Fort Worth, Texas. And we specialize in investment management, financial planning, estate planning, real estate investing, and we've been in business since 2007. We serve clients throughout the United States. So a little bit of housekeeping before we get started. All of you have access to a chat feature, so if you have any questions, please don't hesitate to type those in, and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email, so if you miss something, don't panic. You'll have the ability to watch this again. And you're welcome to forward these presentations to any of your friends and family that you think would be beneficial, okay? So let me introduce you today to our speaker, Tom Howard. But before I do that, let me also tell you this webinar is purely meant to be educational and it's not tax or legal advice. And you'll need to talk to your licensed professional before taking action on any of the information in this presentation. If you'd like more information, including key disclosures, please visit our website at stripmatterwealth.com. Now I'll introduce you to our speaker, Dr. Tom Howard, PhD. He is the CEO and head of research at AthenaInvest. Tom is the founder of Athena's patented behavioral approach. Now, building upon the Nobel Prize-winning research of Daniel Kahneman, Tom is a pioneer in the application of behavioral finance all the way to investment management. Tom is the author of Behavioral Portfolio Management and the co-author of Return of the Active Manager. Dr. Howard is a professor emeritus at the Ryman School of Finance, Daniels College of Business at the University of Denver, where he taught courses and published articles for over 30 years. So without further ado, I'm going to hand it off to you, Tom.
Thank you, Kelly. And thank you for joining us today. As Kelly mentioned, we are going to be talking about the active passive management, a closer look. Again, I am Tom Howard. Lambert Bunker also contributed significantly to this presentation. And he's the person that you can contact if you have questions after the presentation. As we are a behavioral shop, we focus on behavioral factors in making our investment decisions. And this is based on, and it's been supported by the Nobel Prize recognizing a number of key researchers in this area. Daniel Kahneman in 2002, Bob Schiller in 2013, and Dick Thaler in 2017. There's many, many others that are doing research in this area, and it is an alternative to modern portfolio theory. And again, one we think is the best way to think about markets and individuals. In particular, the key conclusions are that people are not rational. And of course, when you say this, people eyes roll as of course they're not rational. We deal with them all the time. And then markets are not informationally efficient. Again, those of you that spend time looking at markets, this is again not a surprise in terms of general conclusion. These particular concepts are how we build our foundation of behavioral investment management here at Athena. So here's the foundation, and Kelly already mentioned a number of these things, so let me just kind of quickly go through it. Again, I was a professor at the University of Denver for 30 plus years, started out as a true believer in modern portfolio theory, but then transitioned to behavioral finance when the empirical evidence turned dramatically against modern portfolio theory. Based on our research over the last 20 years, we have 6 US patents and international patents, and the particular concepts we developed are fund strategy categories, fund ratings, market barometers, active equity opportunity, stock ratings, and fear ratios. We'll refer to a number of these in our discussion today. Again, I've written a number of books, and as Kelly mentioned, behavioral portfolio management is the one that is the most popular. So the active passive discussion, I imagine you have been involved in this at one time or another. And again, the discussion is, should you be an active, and we're going to be talking specifically about stocks today, should you be an active stock picker, or should you just invest in a passive index? And there's strong feelings on both sides of this issue. The ones that believe in active management believe that they're a stock picking skill among active managers, and that they are able to beat a passive index. On the other hand, and they're generally associated with the efficient market hypothesis, believe it's a fool's errand to try to beat a passive index by stock picking. Let's talk about the spectrum of active passive. On the passive indexing side, you have the true indexes, the equity, US and international, things like the S&P 500, broad global indexes, and so forth, fixed income, bills and bonds, cash, and others. So these are the passive indexes, and these are the ones that you would consider investing if you believe passive is the way to go. In the middle here are market segments: style, sector, country, factor. There's just literally thousands of these kinds of portfolios out there that focus on these particular segments. And then individual security selection, and we're stocks, bonds. This is where you are a stock picker, or you decide which individual bonds you want to buy. And this is active security selection. We're primarily going to focus on the two extremes here, the passive indexing and the active security selection. So what are the key questions in this particular debate? Does active management outperform passive indexing? If so, how often does this happen? How do we identify the opportunities when it does happen? And again, for stock selection, we're going to talk about the best stocks of the best funds as we build our active equity portion of this portfolio. And then the other one is market exposure. We're trying to identify the best markets. So those are the basic questions we're going to try to address today. So let's talk about active equity opportunity. And this is a way to identify the time periods in which there's a greater chance for active equity to outperform a passive index. This is a study that was done by Morningstar and Hartford funds, and they compared the performance of the actively managed large blend, which is the blue line here, and then the passively managed line, which is the green line. And this goes back to 1985 up through 2019. And you can see there are periods in which the passive outperform, and there's periods when the active outperform. And so what we're going to try to do is identify those periods. Are there objective measures of market environment that allow us to identify the times when active has the best chance of outperforming? There's been actually a fair amount of academic research in this area looking at, again, objective measures that are predictive of when active equity managers will outperform. The first one of them is individual stock intra-month return dispersion. So in a particular month, you calculate the returns on all the stocks out there. And then measure the dispersion of those particular returns. And the greater the dispersion, the more likely is it that active managers are going to outperform. In other words, it appears that those are the opportunities in which stock pickers are able to identify those stocks that will outperform going forward. So that's an important one. Again, intra-month return dispersion. The next one is skewness. Skewness, when you think about a distribution, is that the right or positive returns are bigger than the left or negative returns. And the positive skewness means that the positive returns are bigger than the negative returns on the other side of the distribution. Turns out skewness is incredibly important for generating returns, not only for stock picking, but just stock portfolios in general. So positive skewness and increasing skewness is an indicator of a period in which stock picking has a better chance of working. The next one is the SIBO volatility index, or VIX, very well known in the industry. So the more volatile the markets are, the greater the opportunity for stock picking. And so here, investors are driving returns in very widely up and down. We've been through these periods. Right now, volatility is quite low, relatively speaking, but we've gone through periods of much higher volatility in the last few years. Those are periods that are attractive for stock picking. And finally, the expected small cap premium over large, or we just call it small cap premium. So these are the four drivers that we've identified and have been researched, provided in the academic literature. And this is what we use for anticipating when stock picking has a best chance of working. So this is the active equity opportunity, or AEO for short. So this particular graph is 97 through July of 2023. And the black line is the median value. So these values go from 0 to 100. So that's the median value is 35. So anytime AEO is above 35, that's a better opportunity for stock picking. And if it's below 35, it's better opportunity for a passive approach. And so you can see up till 2010, there was really a lot of periods where stock picking was favored. There was a very, very favorable environments for stock picking. Starting in 2010, all the way through 2020, it was an environment where passive was more likely to outperform the active strategies. So that was a 10-year, basically a decade, where AEO was below its median. Starting in 2020, that changed, and now we've been for about 3 years. We've been in a period where AEO has been above the median of 35, and it's been an attractive stock picking environment. Here's what the performance looks like. Based on AEO, overall, all of the stocks picked, and there's 500,000 month stock, or nearly 600,000 month stock observations in this data. And the average stock during that time generated a return of 89 basis points over, I mean, these are the stocks held by the mutual funds, generated an 89 basis points advantage over the average stock held. And the average stock we're looking at here is the S&P 500 equally weighted index. So in other words, over this entire period, there's evidence of stock picking skill by active equity mutual fund managers. If you go to an AEO of less than 35, that number turns negative. In other words, the stocks selected by mutual funds, active equity mutual funds, underperform the average stock. And then finally, if you go to an active AEO greater than 35, it dramatically outperforms. This is the period, these are the situations in which active equity managers have a very good chance of outperforming. Notice that overall it's 89 basis points per stock. And these are annual. fees are typically greater than that. So that's why when studies look at the average performance of active equity managers, they underperform. That is indeed the case that we see here. So let's look at the active equity portion of our portfolio, in particular stock selection. We're looking for the best idea stocks of the best funds. We refer to this at Athena, we've called these stock diamond ratings. So what are the best active equity funds? Again, we use all behavioral measures. We want narrowly defined strategy consistently pursued and taking high conviction positions. Another way to measure that is a low R squared to the benchmark. So those are the best active funds. The best idea stocks are most held by these best funds, and we refer to those as DR5 stocks. And again, the best funds are strategy, consistency, and conviction. The worst idea stocks we refer to as DR1. These are stocks least held by the best funds, and on the flip side, most held by the worst funds, which are closet indexes. And as you know, many of the funds that are call themselves active are really truly closet indexers. So our DR1 stocks are mostly held by closet indexers. Here's the performance of the diamond ratings. Again, returns to skill. How much better do the stocks perform relative to the average stock? And you can see that the overall, again, is 89 basis points, which we saw earlier. The DR3s, which are the mid, have a little bit of an advantage, but then you go down to the lower ones. These are the ones held by the closet indexers. You now get a negative performance. So the diamond ratings are able to sort stocks held by the funds, and we rate about 3,000 stocks every month. We're able to sort the stocks that are underperform, the DR1s and DR2s, versus the ones that can outperform, which are the DR4s and DR5. So those are pretty dramatically superior returns. And this is where the active equity funds generate, if they're going to generate a superior return, this is where they would generate it. So there are about 10,000 stocks in the stock market counting pink sheet. If you eliminate pink sheets and only go with stocks that are traded on exchanges, there's about 6,000. And mutual funds hold about half of those, about 3,000. So the funds we rate, the DR5s, they represent about 10%. So every month we have about 300 DR5 stocks that we identify. So let's turn to the market exposure part. This is a chart showing the performance of the 4 markets we use for managing our portfolios: international developed, US small, US large, and cash equivalents. And we have ETFs that we invest in for each of these markets. You can see that over this 10-year period, the top performing markets vary. US large cap outperformed in 5 of the years, cash 1 year, international developed 2 of the years, and US small cap in 2 of the years. So there's a cycle to the markets. And so we want to try to identify when each of these markets are going to do well. We do that with our behavioral market barometers. I think many of you are invested in our global tactical, and we use that market barometers for managing that portfolio. And this is based on our 10 strategies. Again, one of our patents, we identified 10 equity strategies. We've been doing this since 2007. Strategy identifying mutual funds, US and international domiciled in the US. And the long-term ranking from 1988 through 2007, the future growth is the best, competitive positions next, all the way down to risk. If the current strategy ranks align with these long-term ranks, that's a very good sign for the markets. And so we have a very high expected return. If it's mixed, which is the most typical case, it's median. And we set a 10% average return or expected return in this for this particular category. And then if it's inverted, where risk is ranked towards the top and future growth to the bottom, and the other rankings are in there, but those two are the two of the biggest drivers wherever risk is met. So if in fact investors are rewarding risk and not rewarding future growth, I think that's fairly intuitive. That's not a good market to be in. And in that case, we can sometimes be in cash. And in global tactical, up until just a couple of weeks ago, we were in cash for about a year based on that. So the returns, we think of the returns distribution shifting with the market barometers. So normal, we have a long equity exposure, so that's kind of the mid-range. If it gets really strong, we'll leverage our equity position in global tactical. And if it's weak, we'll get defensive, even to the point of going into cash. So here's the performance. This is global tactical. Been tremendous performance on this portfolio. So that market barometers seem to be a strong indication of which markets are going to do well. We outperform in each of the time periods. For the 10-year, we're number one out of 175 funds. And we've been Morningstar 5-star every quarter now for 8 or 9 years. So it's not only outperforming, but it outperforms persistently. So putting all these things together into an active passive portfolio, the dynamic aspect of the portfolio is based on AEO. So when AEO is low, we invest less in active and more in passive. We use 40% active. In this case, it's 60% passive. And then when AEO is greater than 35, we switch it up and we do more in active and less in passive. So this is the dynamic portion of the portfolio. And again, based on when it's more likely that active equity stock picking is going to be successful. So here's the dynamic portfolio manager. We just talked about the active mix. We use the best equity funds and the best ideas stocks for the equity portion of that, the active equity portion. For the best markets, we use the market barometers and then decide among large cap, small cap, international developed, or cash. So here's the performance. This is a hypothetical growth of this particular well, I have moved on to the statistics, so there it is. So this is the performance. You can see it's outperformed over this period of time of 16 years. Our benchmark is the Morningstar Global portfolio, and you can see it's done well. So here are the statistics. You can see that over this 16-year period, it started out with 10,000. The benchmark generated 23,000. The ending value for the portfolio was 53,000. 11% return for the portfolio and a 5.4%. So we more than doubled the benchmark. Again, each of the periods other than 1 year, it's outperformed. Going over to the statistics results, standard deviations about the same. Beta 0.9, R squared 0.79, which is again very attractive. The upside capture is 104%, downside capture is 77%, and the max drawdowns are lower for the portfolio than the benchmark. So this portfolio generates very attractive returns. and also is very attractive for diversification purposes. So here's the required disclosures. And at this point, why don't I turn it back to Kelly?
Thank you very much, Tom. That was definitely informational, very enjoyable. If any of you have any questions, now would be a great time to go ahead and ask them. You can use your chat feature down in the bottom and go ahead and type those in, and we will get those answered for you. So Tom, while we're waiting to see if anybody has any questions, what are your, I know it's not exactly what we just talked about, but with the Fed having just raised rates, what are your thoughts going forward?
Yeah, I think the Fed has done a pretty good job. I mean, they were the ones that caused the problem in the first place by pouring a bunch of money in a few years ago. But they've actually, I have to say, and this is unusual for me to say this about the Fed, they've actually done quite a good job. I think we have a pretty good chance of a soft landing. Again, we got GDP this morning, which was better. And the inflation is coming down. So I think it'll really a nice job for them. But they shouldn't get too excited about my compliment to them, because boy, they can sure mess things up at time. And I've been around for 40, 50 years watching this, and it's unbelievable. But I have to say they have done a very good job this time around.
Oh, fantastic. Thank you for that. At this time, we do not have any questions. So I want to say thank you again for joining us today, everyone. Please visit stripmatterwealth.com for our calendars of events, and that will include our webinar schedule as well as future classes that we'll be teaching here in Fort Worth at the local colleges. You can also sign up for our weekly market newsletter as well as our monthly retirement ETH newsletter. So thanks again for joining us, and we look forward to seeing you soon. Y'all have a great day.